Hello, everyone, and thank you for being here. I am Abby Cruz King. I am the digital marketing specialist here at Myriad. We provide marketing, tech, HR, and a lot of other business solutions to financial professionals. We're really excited to have Mr. Rosenberg here today to discuss cash balance plans to target high net worth individuals. He has prepared a presentation for you all, and once he's done, we'll have a time for a live Q&A, so be sure to drop your questions in the chat there. There will also be a recording of this webinar sent out to everyone who registered, so check your emails tomorrow for that. And now I will pass it off to Mr. Rosenberg.
Thank you, Abby. Thanks for the formalities, but around here I'm known as Charles. So you can call me Charles, and I appreciate it. Thank you for the phenomenal turnout we've had today on this webinar. I know Abby mentioned there's a few hundred advisors, probably some CPAs included as well. So it just gets me really jazzed up to think about how everybody wants to learn so much about cash balance plans. And Abby mentioned waiting to the end, but it is a short, very high level presentation. So if you do have questions, maybe, put them in the chat so that if I'm missing something as we go through, please feel free to go from that point forward. So, and like I said, Abby's in charge. I'm just talking to a computer screen from here. So today's goals, help you understand what is a cash balance plan, identify key similarities between a profit sharing and a cash balance plan, what and why the hype. Why is everybody talking about it? And for those that are not doing it, what are you missing out on? What's the FOMO here? Type of businesses that are typically good for a cash balance plan. And let's get comfortable with it so you can start proposing cash balance plans. Just a little bit about myself and the firm that I represent. I am part of the National Future Plan team. We are what we call Team Intac in Northern Jersey. We have a sleeve within the Future Plan family. Through Future Plan, we administer probably over 40,000 retirement plans. Through our team in Northern Jersey, we have over 1,000 defined benefit plans, and we're probably putting in about 150 cash balance plans a year. So very familiar, seen a lot of it, and typically I am working with clients and advisors to help them identify what the best solution for them is. And you'll get a follow-up to this webinar, with a little bit of background on who I am and a couple of one-pagers on this. So just to kind of jump right into it, like I said, we're not going to go the full hour here. This is a very high-level presentation just to give you a little bit of a taste of what is a cash balance plan and where is it valuable to your clients. And Abby, like I said, I have no idea if everybody hears me or sees me correctly. If I'm missing something, just please jump in on it. So types of qualified plans. So on the left side of the screen, we talk about a defined contribution plan. That's your classic retirement plan that you guys have seen forever. These are just going to get the screen out of my way here. These are classic retirement plans, profit sharings, 401ks, money purchase, which we don't see a lot. And within a defined contribution plan, as in what the words mean, we're defining the contribution. So if we're doing a pure profit sharing plan for 2023, the IRS limit is $66,000. So the contribution is limited. We're defining the contribution. The corporate deductible limit is 25% of eligible compensation. So, and again, we'll show you examples as we go through it a little bit later. But for argument's sake, if we have a company that has $1 million of total payroll, the maximum the IRS allows them to deduct within a defined contribution plan or a profit sharing plan, as we call it, 25% of that payroll. Okay, so now a number of you are probably asking the question, well, isn't the limit $73,000 if you have a 401k? That is correct, because there is a catch-up of $7,000 it within a 401k plan. So on top of the 66,000 that you can combine between a 401k and a profit sharing, when you do have a 401k combined, and again, we're going to go through these examples a little later, you can actually put away up to 73,000. Again, the two limitations, to be very clear, are the dollar limitation of 66,000 or 73,000 with a 401k, and you're limited to a 25% pay deduction. Now let's go to the right side of the screen. Defined benefit, very different. We want you to think very different when we talk about a defined benefit. A defined benefit is we're defining a benefit at retirement. So I'm going to go to the second bullet first. We are telling our client that we are going to fund a plan that, think of it as an annuity, that we're going to pay you $265,000 a year. So the IRS allows us to fund a plan limited to the lesser of 100% of compensation, not to exceed $265,000 a year. So as you can see, we're not funding the dollar amount of a deposit of $66,000. We're funding a benefit of $265,000 a year. So again, and I know a number of you on the phone, on the call, are very technical. So like I said, I'm going very high level, and this is really geared for more marketing. But just for example, if someone gets hired at age 60 and we want to fund a plan for that 60-year-old, we will be able to fund a lot more for that 60-year-old versus if that person was 40, because we are going to shoot to pay this person $265,000 a year for the rest of their life. And again, actuarially, we figure out what their age, life expectancy and all that, and that's why you need an actuary for it. Again, the key is we're allowed to fund a plan to provide a benefit of $265,000 a year, and if we are doing a lump sum payout, it's about $3.4 million. And I'll get back to that number soon as well. Again, the key difference here is the corporate deductible limit is the amount necessary to fund the defined benefit plan. We're not limited to $66,000. One key difference between a defined contribution and a defined benefit, as the last bullet that I didn't cover earlier, is that in a defined contribution plan, each individual has their own account balance. So if I start out with zero and I put away $66,000 in 2023, typically, each individual will have their own account balance, and I invested it in a 5% fixed account. If I can find that, my balance would be $66,000 plus 5%. In a defined benefit, you'll see as we get through it, we actually do not give you a account balance for your individual contribution. Any questions so far, Abby?
Let me check. No, I don't think so. Not yet. You're good to go.
Right. Again, so just looking at different age bands. So when people call me for a defined benefit, I like to give them just a round number. So if we're talking a 60-year-old, age 60 to 65, typically when we do a defined benefit, and again, one of the bullets that I skipped over earlier, I'm sorry, was that when we talk about defined benefit, we're talking about a traditional defined benefit and cash balance plan. Cash balance is a type of defined benefit plan. It's just we're allocating a percentage of pay differently by participant versus a traditional defined benefit plan. We're kind of looking at the group in total. So a 60-year-old in a defined benefit plan would get a contribution of upwards of, I would say, between $300,000 and $350,000. In a defined contribution plan, if they had a 401k and a defined contribution, they'd be limited to $73,500. As you can see here, anybody over the age of 50 would get that $73,500. But as you get younger and younger, the defined benefit contribution does go down. So if a 40-year-old, we were putting in a defined benefit plan for a 40-year-old, that contribution would only be $126,000. And as we get through this presentation, you'll see how we marry both worlds. We in a cash balance plan, we're bringing the defined contribution and the defined benefit together. So what exactly is a cash balance plan? Okay, I call it the best of both worlds. We're combining a 401k profit sharing plan with a defined benefit. Let's see what that looks like. So we create, in a cash balance plan, we create what I call a phantom account balance. So although the money, and we'll talk about this soon as well, although the money is invested in a pooled account, and just as an aside, I always tell advisors, our typical cash balance plan is a contribution of over $1 million a year. If you're an advisor and you're managing $1 million account, I would typically think you're charging upwards of about 1%. If you're doing a 401k plan, if you're charging more than 50 basis points for that plan, you're going to have a lot of competition, because it's going to be someone coming in behind you and saying, why is that guy charging 1%? I could do it for 50 basis points. In a cash balance plan, what you're charging is not public knowledge. It's between you and the client. And most of our advisors are actually charging upwards of 1%. However, us as the actuarial firm, we are taking that pool of money, that $1 million, and now breaking it down into an account, a phantom account balance broken out by participant. It's portable. So ultimately, the way we design defined benefit plans, and I know a number of my friends are on the call here, been in the industry a long time, the classic defined benefit plans, many of them had annuities. We weren't able to kind of liquidate them easily. In a cash balance plans, they're really designed to make them very portable. So if someone terminates, we know exactly what their balance is based on the phantom account balance that we gave them, and we can easily roll it over into an IRA, excuse me. A big item, which we've seen a lot recently, is creditor protection. We have a lot of physicians that specifically keep money in a retirement plan because of the supreme creditor protection. So again, it's the same as a 401k plan. The money is creditor protected. However, in a 401k plan, what makes it different is the employee will elect their deferrals, they'll elect their investments. We don't do that in a cash balance plan. We have flexible contributions. So in a 401k plan, if I put away $30,000 this year, next year I can go to zero, or I can go to anywhere in between. Same thing with a profit sharing plan, individual investments I covered. In a cash balance or a defined benefit plan, it is a corporate contribution. So let's just use the $1 million number I threw out earlier. The $1 million is a corporate contribution invested in a corporate retirement plan pooled account at the custodian of choice. Fixed contributions, I would say this is a little bit fluid, but typically you're going to get a contribution of a similar amount for, in my example earlier, my 60-year-old. For the next 5 years, that 60-year-old is going to have the same contribution. So it's not flexible contributions. And that's important. So we get this call all the time. I've got an attorney that just won a large case that they represented, and the attorney made $2 million, and they want to defer $300,000-$400,000 of that. But next year, their income is not going to be the same. So we discourage them from a cash balance plan because the IRS does not want a defined benefit plan to operate like a profit sharing plan, where you're going to be flexible on your contributions up 1 year, down 1 year. Again, with that said, a good actuarial firm like ours, we can work with you to a point to make it a little bit flexible. But there's definitely going to be a contribution. There's definitely has to be a commitment. So when we sit with potential clients, we say, okay, what kind of business are you? Do you have repeatable, predictable income that we can say we're going to put away $1 million a year? Pooled investments, as I mentioned earlier, typically the client's going to work with a financial advisor that is going to give them a very conservative investment. And we'll talk about that a little later as well, but I want to cover it now because sometimes I forget to cover it later. A defined benefit has a couple of components. one component is, in the case of a cash balance, it's going to be a percentage of pay. So my business owner makes $300,000 a year, and we're going to give them 50% of their pay in a cash balance plan. Inherently within the plan, there is a written rate of return that's expected. Typically, our plans are written between 4 and 5%. So on $1 million a year, that plan is expected to make $50,000. Again, it doesn't happen immediately, but let's assume that $1 million was put into a money market account that's paying 0.1%, if you have that kind of money market. Eventually, the business owner is going to have to make up that $50,000 a year loss, because we are committing to providing a 5% return. So the job of the financial advisor is a little bit more complex versus a 401k, because you really have to work with the client to get them a laddered bond portfolio or something a little bit more on the fixed side that can give them that 5% return. I know I've said a mouthful and I've put a lot at you here, but this is a really good schematic of kind of bringing 401k where it's similar, where it's different, and kind of understanding the differences between the two. I'll stop here for a moment if there are any questions.
No questions yet. I think you go right ahead.
Okay, great. So again, when we talk about the best of both worlds, cash balance is a type of defined benefit plan that combines the high contribution limits of a defined benefit plan with the flexibility and portability of a 401k plan. Now here's the big number that I mentioned earlier. Participants can amass a lump sum of up to $3.4 million at age 62. Now, one of the things that people that do cash balance plans appreciate is that you are working, when you do a defined benefit plan or cash balance plan, you're working with a very knowledgeable, technical professional. And our actuaries, our team in New Jersey, we've got 4 actuaries on staff. We run that balance, like how do we fund the plan to get you to $3.4 million, but yet manage that $265,000 a year limitation. So, but if someone starts at age 50 funding a defined benefit plan and they've got a lot of runway, so to say, till retirement, we are going to fund the plan to $3.4 million. Now, I've had this and probably have this phone call more so in the last years, but not in the last 12 months. We've got people that say, hey, I've got $1 million in an account. I don't want to invest it at 5%. I want to invest it at, I want to go into the market. The market 2 years ago was doing 30%. I want to go into it. Now, if that participant, instead of having 3.4 million at retirement, has $3.6 million, that plan is overfunded. So again, when I say you need to appreciate the professionals that are working with you, a cash balance plan is not an off-the-shelf plan. We need to work with you and coach the client year by year to see where we're at funding status. Are we overfunded? Are we underfunded? What are the options? There's a lot of moving pieces. And the IRS requires us to sign off as actuaries to kind of certify that the numbers that we're allowing our clients to deduct are permissible. So again, I say that because I really want to put the appreciation of what's involved, and they're expensive. You're typically looking at a small company probably costing about $5,000 a year to do a cash balance plan. A cash balance plan can show the benefit as a lump sum, as is done in a traditional defined benefit plan. And as I mentioned earlier, participants can choose to have the lump sum rolled over to an IRA upon termination, or 59.5. Again, you can read the bullet here. So just some limit tables, and again, just another reference point here, kind of putting it on one schematic. So typically what we're doing is we are, and you'll see the example later, but kind of the intro to the next piece here, is that 65 to 70-year-old, or let's just pick on the 60-year-old, When we're done with this person, we're actually going to give them a 401k and a cash balance plan, and their total deduction is going to be close to $400,000. Very powerful. And I'm saying this now, and I'll probably say it again. My point, your one takeaway today, I hope, will be, if you're not talking to your clients about cash balance plans, I can assure you someone else is. And we encourage all our advisors, CPAs, that at least have the conversation. Working with a firm like ours, we do complimentary plan design, we show you alternatives. At least clients should have that in their file to know what their options are. We get this question often: can we do a cash balance plan if the client has a 401k plan at ADP or at a bundled provider? Absolutely. And I say the actuarial firm, Future Plan, we need to dictate what the profit sharing plan is. So if we strip out the $30,000 in this case here from our 60-year-old, we need to dictate how much that business owner is going to get profit sharing, how much the employees are going to get. Again, as I mentioned earlier, there's a $3.4 million lifetime limit of maximum funding. So how does it work? As I mentioned earlier, and again, just another visual of this, the contributions, let's call that $1 million. The earnings, in a 401k, the contributions, the earnings give you your total amount. In a cash balance, your contribution and your guaranteed interest rate is going to give you your ending balance on your phantom statement. So for argument's sake, we've got Charles Rosenberg gets a contribution of $100,000 this year in his cash balance plan. I get an interest credit of 5%. So my statement is going to show whatever my beginning balance is, $100,000 contribution, 5% interest, and my balance is now 105 plus my beginning balance. So the phantom statement looks and feels very much like a 401k statement. The difference is in a 401k statement, the individual can look at their statement and go, hey, I'm in fixed account, I should be in value, I should be in small cap, I should be in large cap. So there's a lot more flexibility, whereas a cash balance plan, the only thing they can do if they don't like, let me take that back. They don't have an option. The return is the return. So even if the plan did 30%, which we don't like to see, they're still going to show that 5% return on their phantom state. Stop for a moment. Any questions?
I do have some questions. Let me start with this one. It says, without naming names, can you share some success stories of what you'd consider to be an ideal prospect for a cash balance plan?
That is such a great question. We leave that for the end so people don't drop off.
Great. I'll re-ask it at the end then.
Yes. Well, we're going to have an example. Is that it?
Yes. Yep, that's it.
Great. Okay. So I'm kind of just going to, for the next 5 minutes or so, I'm going to walk through everything we talked about, but I'm going to make it visual and kind of the feedback we've gotten from other seminars. This is really where it all comes together. And then we're going to talk about how do you market it, how do you prospect it, to who do you prospect it, and where are the failures. We'll talk about that as well.
Mm-hmm.
So Jim and Tammy are husband and wife, 61 and 56 years old, and they've got 4 employees. And I would say this is my ideal small client that we can show them profit sharing or 401k. So the first thing that we do is we put in a 401k. In this case, it would probably be a safe harbor 401k plan, and they maximize the 30,000. And obviously, it is a 3% safe harbor. What we do for this group is, because there's a huge age disparity, and again, I'm not going to get into all the technicals because this is a very quick call, but new comparability will allow us to give a total of 5% between the 3% and an additional 2% profit sharing. We're giving 5% to the employees, and Tammy and Jim put away a total of $105,000. $113,000, and it costs them about $7,000 for their employees. Okay, phenomenal, great. But Jim and Tammy typically will come to me and say, that's not enough. So what we do is, for them, we add a cash balance plan. And I'm kind of jumping to the cash balance piece at the end here, which is I'm just putting my thoughts together because I want to kind of plan. So in the case earlier, we saw that Jim and Tammy here are getting 53,000. Disregard the last column where it says cash balance plan here. I'm not sure where that came from, but Jim and Tammy are putting away. Sorry. They're getting a total of $113,000, okay, at a cost of about $7,000. They want to do more. Tammy in this case, I'm sorry, someone mixed my slides up, I apologize. Tammy is older now, Jim was older before, that's why I got confused. So let's focus on this handout. Tammy's 61, Jim is 56. Tammy makes the maximum we can recognize for retirement plans, $330,000. She puts away $30,000 in the 401k. We give her $43,000 in the profit sharing plan, and we give her, based on her age, $365,000 in a cash balance plan. The total contribution for her is $438,000. Her husband, Jim, is not making that much money on the books for them. He's only making $65,000. We maximize his 401k to 30. We give him whatever profit sharing we need to do to make it work. And in this case, we're able to give him a cash balance contribution of $90,000. Total contribution here is $562,000. Now, here's where it gets interesting. The IRS allows us to recognize money put into a profit sharing as well as money putting into the defined benefit plan. That's the beauty of the cash balance plan. So we are actually aggregating the two contributions. We typically will design, and most practitioners will design, the larger chunk for the employees in a profit sharing plan. It's a technical issue, but there's a reason we do that. Another practical reason is that the employees get to invest most of their contributions on their own, and there's less of, well, why am I only getting 5% on my money, etc. So typically, this is how we design a cash balance plan. We'll give each of the employees 7.5% of pay, and we take a portion of that 7.5% of pay, and we put it towards the cash balance plan, or sometimes we do an additional flat amount. Again, I always like to tell a client, based on the layout we had earlier, assume you're going to be giving your employees anywhere between 8 and 10% of pay. So if my example earlier, my business owner has $1 million of pay, and we subtract the owners at $500,000, assume that for the employees, it's going to cost you anywhere between $40,000 and $50,000. That's a quick back of the envelope way of thinking about it. But look at the numbers where they shake out here. Let's assume, Jim and Tammy are my company. I'm getting a benefit of $563,000 at a cost of $13,000. Now, it's a no-brainer, right? The problem is there are a lot of issues that we need to make the client aware of to go into it. But this is a perfect scenario for a cash balance plan. Predictable income. Let's say Tammy is an architect, a professional, a physician. She's got predictable income. Jim is on payroll. Maybe he's the office manager for her. This is a phenomenal situation. It gets a lot more complicated when you've got 30 employees, or you've got law firms, or you've got another group of employees that are highly compensated. Again, my more intense, more technical presentation will talk about how we deal with those. But like I said, the concept of this presentation was to give you a taste of where the power of these cash balance plans are and how much money business owners could put away, yet not that much for their employees. Now, where doesn't it work, right? So the question earlier, what's a good example? We'll talk about that in a moment. Where it doesn't work is assume all my employees here were age 55 or age 60, or maybe even older than Tammy. So the age disparity is really what helps it work here. If I had a bunch of 58-year-olds or 65-year-olds, the cash balance would not work. Because it is a defined benefit plan, and the closer someone is to retirement, the more we can fund them. I'll stop there for a moment. If there are any questions.
I do have a question here. It says, can you talk about the 5-year minimum that the employer has to commit to for ongoing annual contributions?
Okay, that's a great question. So I mentioned earlier that I used the example of the attorney that won a case, and they were looking to put away a lot of money on $1 million. The IRS, and again, depending on the actuary, but at a minimum, the IRS wants to see these plans set up on a permanent basis. It's called permanence. In our firm, typically we say a plan has got to be around for 3 years. Now we say got to be around is that, let's use this one attorney. This attorney, him or her, we get him a contribution of, let's call it $450,000. In year 2, he or she decides that they can't contribute to it. They want to freeze the plan. We can't terminate it like a 401k plan. We've got to freeze it. And typically we need to see that plan stay alive for a minimum of 3 years, sometimes up to 5 years. So we can't flip in and flip out of these plans. Another practical issue is that these are expensive. When I mentioned earlier about a plan like this costs about $5,000 to administer, it costs about another $3,000 or $4,000 to set up. So you're looking at $8,000 to $10,000 the first year of a plan. It's got to make sense. You don't want to do this for 1 year. So from a legal perspective, definitely not. From a practical perspective, definitely not as well. So the question earlier was, who is ideal? Here we go. Professional service firms, including medical groups, CPAs, law firms, financial services, anybody who has predictable income that can solve that permanence issue is who we recommend going to it. Anybody that has just a blip on a screen of increased revenue for 1 year, will typically discourage them from that. So professional service firms, ologists, law firms, we're seeing a lot in the venture capital. As you can imagine, we're, in New York, New Jersey area, we're probably putting in a lot of, not probably, when I say probably, we're putting in probably 1 a month for firms like that. Typically those firms have about 10 business owners that are making each $1 million a year. They've got a staff of about 20 people. Companies with 1 to 500 partners. Future Plan on a whole, we have a cash balance center of excellence, which is the former Kravitz company. They do a lot of the larger cash balance plans. On our team, we typically see 1 to 50 lives. That's our typical client. We've got a couple of plans that have a few hundred, but the larger plans, we certainly have the capability. They're not as attractive. That's the issue. The other thing is, if any of your clients have a new comparability plan, I would say cash balance is something that you should have your consultant or have us run what cash balance plan runs. For new comparability profit sharing allocation, the underlying mechanics of the plan is very similar to a defined benefit plan. So if new comparability works, you've got enough of the age disparity to make it work, cash balance is going to work as well. So wrapping up here, any other questions, Abby, before I kind of bring this home?
I do have one question here. It says, what is the best way to start a conversation with my, what is the best way to start a conversation with my high net worth clients about cash balance plans?
Great. We're going to cover that in the, we're going to cover that in this wrap up slide.
Perfect.
So, reaching out to business owners. I get this question literally every day. You know, what's my angle? How do I talk to an existing business owner? So before we talk about business owner, I always, when I talk to an advisor that's just getting started in the retirement space, typically you as advisors have a large book of business that are business owners. So the first question to ask is, do they have a retirement plan? Have they ever considered a retirement plan? What does their retirement plan look like? If they do have a 401k plan, I would ask them if they're maxing out, if they're getting the maximum benefit they can out of the plan. I will say 9 times out of 10, your business owners will tell you, it's great, but I'm putting away $30,000 a year. Can I put away more? The first then follow-up point is, can we set you up with a profit sharing plan that you could put away upwards of up to $74,000 a year? And then the conversation is based on what I showed you earlier, and you'll get a follow-up from us as well that has that chart. You know, if that business owner is 55 years old, they can be putting away $250,000. Would you be interested in putting away $250,000? Would your partner be interested in putting away, you know, $250,000? Now, one question we get often is that, let's say Abby and I are partners in a firm, and Abby, you know, Abby is clearly a lot younger than I am, and she's not ready to put away $250,000 in a plan, and maybe in 10 years she'd want to do that. So can Abby put away maybe $50,000 and I put away $250,000? The beauty of the cash balance plan is that we're able to allocate a specific percentage of pay to specific owners. So question earlier, a good example of this. I had a group of cardiologists located here in North Jersey last year, and they asked me to come in and present to their partner group about cash balance plan. And I looked around the room, and there were partners that just became partner, and there were partners that are just about retiring. So the 3 partners that were retiring said, we want to maximize. I said, okay, can we get you to a $400,000 contribution? And they said, absolutely. You know, and then somewhere in the middle, we kind of did $200,000, and the starting partners waived completely out of it. So there's a lot of flexibility in the design, as well as if we need to change it ongoing. The key is, and again, this is what I said earlier, the value of working with a professional is that we need to coach you and your client to tell you what is allowable, what is not allowable, what we can do, where is it flexible, where is it not flexible. So reach out to your business owner clients. Law firms are really good candidates for this. Physician groups are great candidates. We've got a lot of accounting firms that are candidates. Like I said earlier, private equity, venture capital firms. We're doing this a lot for people in our community, in the financial services community. So I would say professionals is probably where we shine in the cash balance world. However, there are other options. You know, we start with profit sharing, we go to cash balance, and the point is I always end with this: is you want to partner with someone who can actually give you all the available options. We're not selling just cash balance plans. We're selling the right solution for the client. That's what we want to partner with you guys to help you to add value to your clients. We've got some collateral. We've got the cash balance coach, which is part of the Future Plan family. We've got the book Beyond the 401k, and all this is available on cashbalancedesign.com. So with that said, I'm going to wrap it up. I'm going to skip the next piece because we're kind of over on time and it's quite technical. But thank you from all of us at Future Plan and Team Intact in North Jersey. Thank you for listening and thank you for being here. Abby, are there any final questions?
There is one question here that says, can sole proprietors do it?
Absolutely. Every business owner, every tax filing person can do that. So S Corps, C Corps, LLCs, we all can all do that.
Okay, that is our final question. Thank you everyone for being here and taking time out of your busy day to learn about cash balance plans. And thank you to our host, Charles. Keep your eye out for the email that you'll be getting tomorrow. And I hope everyone has an awesome day.
Thank you very much, everybody. Thanks for listening.
Goodbye.